question is, where do you think we are in markets right now? You know, is this a sideways 1 year consolidation? So we've kind of been in a bear market, but in a very different kind of structure to the previous ones, you know, or do you fear it goes lower? What's your hunch here? I'm not going to put a gun to your head and say, you know the
price
answer.
Prediction for the end of the year.
One thing's interesting. I've known that traders have come into the space. There's a lot of people come from two areas, one from commodities,
right,
and one from emerging market FX.
Yeah.
Because they're people who understand risk.
Yes, that's right.
And volatile assets, and
yep.
how to run risk with volatile assets, because most people don't have that skill set. It's very different. You know, what was fascinating is I started talking about the adoption and saying, it reminded me a lot. I was at Goldman back in the late 90s,
right,
and the GSCI had come out, and I was servicing hedge funds, so we were all talking about that and how people can get involved. And then you wrote a whole piece on it. Talk me through this, because it was bizarre, because you'd come at it exactly the same way and said, look, this is really similar. We've seen this before. Yes, I mean, the correlations go to one in these kind of risk events, right? Everything is correlated in a risk event. Also, what I notice about crypto is it has a passing correlation to stuff, passing to the yield curve, passing to rates, passing to equity. But it's not the overall correlation, because if you look at over a long enough time horizon, it's not correlated to anything. I think that's the key point, right? I just wrote a piece for Global Macro Investor over the weekend. You know, I've been, as you know, using Metcalfes Law for this. Yeah. And from my numbers, using the crypto, I think it's crypto.com, blockchain.com numbers, there's 300 million users. It's growing currently at about 185% a year in all of crypto, which is twice the speed the internet was growing at the same kind of phase. Looking at the number of years after there was 5 million users. So that's how we kind of anchored it. It's growing at twice the speed, because obviously it's a network built on top of a network of networks. So mobile phones and data, then internet, then crypto. So you get, you know, I think it's called Reed's Law, which makes it even more exponential. It gets all ludicrous. It's just,
I mean, as I say, the internet didn't have the internet.
No, exactly right. It had the mobile phone network and the landline network, but you know, it's all of the kind of thing. Also, what I did is I had a bit of a breakthrough this weekend. Is I tried to figure out, okay, what drives price in crypto? And I went through all of the kind of on-chain data, everything, trying to look at it, supply, demand, hash rates, all of this stuff. And basically it was really simple. It was total volume, daily volume.
Right.
And
that's trading volume or on-chain volume?
Adjusted volume. So that's the cleaned up, so the proper volume's not the wash trading.
Yep.
And then essentially multiplied by number of active users.
Right.
And it fits the price for Bitcoin, Ethereum, Polkadot, XRP, everything. It's exactly. It doesn't give you a lead, but it exactly shows the price. And I'm like, okay, this is really interesting, because it kind of is all about that adoption effect, really. I started a fund of funds investing in digital asset hedge funds, because that's a typical institutional product at this stage in the cycle. What I am seeing is, as this narrative shifts to Web3, it's no longer a Bitcoin-only world. In fact, people kind of want a broader exposure. And I know you guys have moved towards ETH and stuff like that as well. How are you seeing those conversations develop?
Yeah, I would say that, so the beginning of the last year, we were Bitcoin only, and less because we were ideologically maximalist in the sense that we thought that, you know, there's one coin to rule them all. It was really just so we're an institutional only business, so we don't have a retail offering. So, you know, we have like certain minimums, you know, unless you're below $5 million of you know, assets, you know, we need to understand like the path to get to that kind of level. And so it's a different cohort of investors. And up until that point in time, there just hadn't been any interest in other assets. 98% of the conversations that we were having were Bitcoin only. And that definitely shifted. And I think part of that was you know, obviously we saw the reemergence of ESG concerns for Bitcoin. I think, you know, from Feb to May of last year, Bitcoin dominance went from 65% to 40%. You know, that obviously meant that we saw this enormous outperformance of alts. So while Bitcoin was tracking sideways, alts went from $500 million of value to 1.5 trillion in a relatively short space of time, and people follow the money. Part and parcel of that also is that everybody starts with Bitcoin. it's relatively easy to understand. And once you've kind of wrapped your head around Bitcoin, the natural progression is, well, what else is there? And so I think we're definitely seeing some of that. So we, in the middle of last year, made the decision to transition from a Bitcoin-only support model to a more multi-asset support model. And you're right, we'll be launching support for Ethereum at some point in Q2, and then thereafter we'll have a committee that will approve new assets for coin support.
I've definitely seen. I mean, if I think of the last 2 weeks alone, I was contacted by 3 of the largest asset managers in the world, of which this is the 4th conversation with their investment teams, who are all setting up digital asset groups. So this is a shift away from family offices and crypto curious firms like, what are we trying to do? I do presentations for investment banks, Goldman and a bunch of others. Now it's like, these are the big boys who are now calling up. What are you seeing? Who are the people calling you to say, listen, Chris, how do we do this?
Yeah, I mean, it's a similar story. I mean, there's definitely activity, in the pension space. It's definitely active. The banks, I think, somewhat, the activity there has. I think they're trying to work out how much they can do until the arrival of things like Mika. And there's actually, the development that we've seen on that front, although, a lot of it's not public yet, it's definitely been very rapid, like surprisingly rapid.
And they don't seem to be fazed by the recent sell-offs, so they're not saying it's down 50%, I'm nervous about this. You're picking up the opposite, right?
That's right, yeah. It definitely feels like this is more consistent interest and I think that's the difference, is that, back then, because it was a sort of less concrete, less secure investment thesis, it was this sort of financial curiosity. When it died down or when it tailed off, so did the interest, whereas this definitely feels a lot more concrete. I mean, I'd be curious to hear from the conversations that you're having, is that sort of similar, is that a similar experience?
Yes. I haven't seen anybody particularly freaked out, in fact, at all. Couple of retail people, it was more volatility than they were used to. Most others are not really concerned about it, and institutions seem to be like, oh, this is fantastic. I just need to get my asset allocation committee to agree the next chunk of capital because I want to put it in. So for me, it feels very different. What we saw, I think last year, if we define some of the phases, I think the MicroStrategies thing was interesting with Tesla.
Yep.
Then, speaking to the Fidelity guys and a bunch of others who speak to these big corporate treasurers, that's kind of dead in the water because of the gap accounting.
Yep.
So then what happened was a stampede last year. $32 billion went into VC.
Yeah.
Because that was the access, the product access.
Yeah.
Because they didn't like closed-end funds, and it was easy to get VC through as a tech investment through the investment committee. So $32 billion went in. But it feels that this next part is the actual markets, which is why I think hedge funds, who have very little capital really, will get a lot of money. And that flows directly into markets. Unlike VC, which flows into the cap table of startups, the hedge fund money actually goes straight in to the markets. Totally. I mean, at every level, from the investor side, so the pension funds and everybody else, the issue is they can't hire anybody. So they're going to have to retool FX guys, commodity guys, and rates guys, depending which part of the market they're looking at. The hedge fund side, the maturity is going up fast, really fast. And, I think the defining player in the space is about to be Brevan Howard, because they've just launched this gigantic Brevan Howard Digital. And, Alan's all over that in building out this kind of world-class infrastructure and make it look more crypto than it looks traditional hedge funds. They've got this group of offices down in Austin. They've also got this incubator. They've kind of figured out the whole space.
Right.
I think that kind of maturity is going to get a lot more people interested, because for this to accelerate, we need market access, products that are institutionalized. And I know a lot of crypto native people hate this, but if you want adoption, you have to make product. The question is, where do you think we are in markets right now? Is this a sideways 1 year consolidation? So we've kind of been in a bear market, but in a very different kind of structure to the previous ones, or Do you fear it goes lower? What's your hunch here? I'm not going to put a gun to your head and say you
What's
know the
price
answer.
prediction for the end of the year?
I'm not going to give you a price prediction for the end of the year either. I just want to know what your kind of level of confidence is in this kind of price structure we've been in for the last year.
Yeah, I mean, it's an interesting question. I mean, it's certainly, to the point that we were discussing earlier, like it feels different this year. So in previous winters, like I was there in 2018. And, that was the first real sort of bear market that I was exposed to. And it just felt kind of different. Like the interest just waned away, volumes dropped away. And they just, everybody was happy just to walk away from it. And quite frankly, was just glad that it all disappeared because it was all just a bit of a headache. This time around, it definitely feels different. So, we're at that state, if you look at the 4-year halving cycle, we're kind of in the middle of that sort of danger zone. One of the interesting things that, some commentators have raised is that, you look at that sort of, the halving cycle should become less relevant over time, just because the drop off in the reward just gets less and less relevant. And so, I think Willy Woo's done a good job of kind of highlighting that, now the emission rate from miners is actually less than the fees earned by exchanges and by the larger products of this world. The mining element of it, the coin-based transactions, are less and less relevant these days than they were. And so I think for that alone, and the fact that we feel like we've come out the other side of this questioning of the investment thesis and this rebrand of crypto to Web3 and metaverse, to me it feels different. Again, to your point, it is the sort of $64 million question. Time will tell, I guess.
Yeah, it's quite interesting because nobody really dares say any longer because we've all got egg on our faces from getting too bullish the last quarter of last year, and then that didn't work out.
Yeah, there's not many laser eyes on Twitter anymore.
No, I was buying, huge size for me calls in ETH, thinking right, this is going to break, and then the whole thing fell apart. So everyone's feeling sheepish. I think a lot of people went through the same thing. And you don't want to get too bearish because you don't want to be that chump either, and you don't want to be too bullish. So everyone's just kind of sitting on their coins and just saying, look, we'll just see what happens. I look at it and think, well, it didn't break the low, and you've thrown literally the worst situation, including nuclear war, at it.
Yeah, you put it like that. I agree. When you've run out of bad news, you tend to find positive price action shortly thereafter. This feels
very similar to the setup from in March 2020, where crypto got annihilated, but it didn't make a low in the middle of a global pandemic where the world had shut down. That was a big signal to me. It's like, okay, something probably changed here. So maybe it's inflation expectations change because of, oil prices and inflation, I think, crimp consumption because wages don't go up. So wages have been negative for a while, or whether it's the fact that growth is massively slowing anyway. Whatever reasons that comes to pass, I think bonds are trying to say that today, where bond yields are starting to fall really sharp. If that's the case, then it just takes off from that alone. So it feels to me like we're really at an interesting juncture, and it feels like March 2020, because you and I are armed also with the information that we know, unlike March 2020, we're armed with the information that the world's biggest asset managers are very interested in buying it. Which in itself is interesting.